I also want to stay within the commodities for a moment because we've seen more pretty extreme moves recently. Gold, silver, and copper saw parabolic moves followed by a sharp reversals. Does this volatility indicate a kind of liquidity exhaustion that could precede a broader market break?
That's one way to look at it. I just look at gold as gold was the kind of market I was fundamentally technically bullish for decades, gold. And once in a career, a market tells you to sell, and that's what gold did. A little bit last year, I think that was a little bit early, but certainly in February. It reached its highest ever versus a Bloomberg Commodity Index. It reached almost a 50-year high versus its 60-month moving average. Now you can go from a 200-day out to 60-month moving average. It's stretched. Not just gold, but silver too. Those markets said sell. To me, it said sell, thank you. But usually these things happen in extremes when people pile on. It's the classic human nature. People pile all the fundamentals that we pointed out years ago. And that to me was the warning. But the theme is typically now gold and silver this year probably put in highs that might last for, if history's a guide, decades. Now, years would be okay. To stay above 5,000 gold, above $100 silver, I think would be a bit of a shocker, but that's unlikely. But the thing is, they front ran this event. Doesn't matter to me whether you believe that or not, but all that matters is the price on the screen. And they did. And if you're in that market and you made some good money, you probably should be selling when they're yelling. And that's what happened. But now it's about what do they mean going forward? So for instance, when you have a velocity of rally like this in gold, you overlay it with the stock market, almost always the stock market peaks. Now, I do that with S&P 500. You go back to 1980 and it shows you it's the indications you get from markets. So I see that volatility trickling over the stock market, and that's still my key theme. It's volatility is just still too low in the stock market. S&P 500 down about 4% a year is wonderful. I fully expect this to be the start of the third 50% drawdown in the S&P 500 since 2000, and we have very good, worthy reasons to do that. Okay, it was the most expensive versus GDP in about 100 years. We had credit spreads the narrowest in about 20 years, and now we have this worthy catalyst for just some normal reversion. So if you look at things like a 20-quarter moving average, which is 5 years in the S&P 500, it's around 5,000. It's normal reversion. Right now we're 6,500. That to me is what's starting. But if that happens, that's going to be all that matters. When beta goes down, all correlations go to 1, and Bitcoin warned us. Bitcoin, by collapsing last year and cryptos collapsing last year, were kind of they led the way up and they're leading the way down.